Cheers to a new year. Don't forget to dot your I's and cross your T's for this upcoming tax season. This is the Issues Watch podcast. Hello, and welcome to the Issues Watch podcast. My name is Nicole DeRosa, Senior Tax Manager at Wiss & Company, and I'm very excited to be your host for the tax episodes. This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this and other episodes, stop right here, hit the pause button, and head over to njcpa.org/nano to find out how. A quick disclaimer, the views and statements expressed herein are my own and not necessarily those of the NJCPA or of Wiss & Company. With tax season looming, it is very important to make sure all of your ducks are in a row. That includes post-year-end tax planning opportunities, familiarizing yourself with the various 2022 tax items, and making sure administratively that you are set up for success. So let's kick it off with 3 post-year-end tax planning opportunities that are still potential viable options for your clients. First things first, retirement plan contributions. Consider contributing to an IRA if you have not already done so. You generally have until April 18th of 2022 filing deadline to make IRA contributions, but the sooner you get your money into the account, the sooner it has the potential to start to grow tax deferred. Making deductible contributions also reduces your taxable income for the year. You can contribute a maximum of $6,000 to an IRA for 2021, plus an extra $1,000 if you are age 50 or older. The maximum amount of elective contributions that an employee can make in 2021 to a 401k or a 403b plan is $19,500, $26,000 if age 50 or over, and the plan allows catch-up contributions. For 2022, these limits are $20,500 and $27,000 respectively. Individuals are now able to contribute to their traditional IRAs in or after the year in which they turned 70 and a half under the Secure Act. Small businesses can contribute the lesser of 25% of an employee's salary or an annual maximum set by the IRS each year to a simplified employee pension plan by the extended due date of the employer's federal income tax return for the year that the contribution is made. The maximum SEP contribution for 2021 is $58,000. The maximum SEP contribution for 2022 is $61,000. The calculation of the 25% limit for self-employed individuals is based on net self-employment income, which is calculated after the reduction in income from the SEP contribution, as well as for other things such as self-employment taxes. Moving on, number 2, Hurricane Ida tax payments. The tax season just never ends. A gentle reminder that victims of Hurricane Ida in 6 states now have until February 15, 2022, extended from January 3rd, to file various individual and business tax returns and make tax payments. The updated relief covers the entire states of Louisiana and Mississippi, as well as parts of New York, New Jersey, Connecticut, and Pennsylvania. The updated relief postpones various tax filings and payment deadlines that occurred starting on dates that vary by state, specifically September 1st for New York, New Jersey, and Connecticut. As a result, affected individuals and businesses will have until February 15, 2022 to file returns and pay any taxes that were originally due during this period. This means individuals who had valid extension to file their 2020 return that ran out on October 15th will now have until February 15th of 2022 to file. The IRS noted, however, that because tax payments related to these 2020 returns were due on May 17th, 2021, those payments are not eligible for this relief. The February 15th deadline extension also applies to quarterly estimated income tax payments that were due on September 15th, 2021 and January 18th, 2022. The February 15th deadline also applies to the quarterly payroll and excise tax returns normally due on November 1st, 2021 and January 31st, 2022. Businesses with an original or extended due date also have an additional time, including, among others, calendar year partnerships and S corporations whose 2020 extensions ran out on September 15, 2021, and calendar year corporations whose 2020 extensions ran out on October 15, 2021. This also applies to calendar year tax exempt organizations whose 2020 extensions ran out on November 15, 2021. And third, last but not least, HSA contributions. Like retirement contributions, the last day to make HSA contributions for the previous year is generally the tax filing deadline of the following year, which means you can make 2021 HSA contributions up until April 15th, 2022. You can contribute up to $3,600 for self-coverage and $7,200 for family coverage. Shifting gears, moving on from tax planning, what's new for 2022? Well, filing deadlines, very, very important. March 15th, partnerships and S corporations are due for calendar year 2021. April 18th, we have our Q1 estimates due. Last day for IRA contributions and HSA contributions, and C Corp due dates for calendar year 2020 returns are due. May 16th, not-for-profit due dates for calendar year 2021. June 15th, Q2 estimates due. September 15th, Q3 estimates due, and extended business returns are due. October 15th, extended individual tax returns are due, and January 15th, Q4 estimates are due. Most important date to be aware of, the IRS has announced that it will begin accepting and processing 2021 tax returns on January 24th, 2022, and that it has updated its programming to accommodate recipients of advanced child tax credit payments and those still eligible to receive amounts from economic impact payments in the form of a recovery rebate credit. IRS Commissioner Chuck Reddick encouraged taxpayers very strongly to file their individual tax returns electronically with a direct deposit option instead of submitting paper returns, which are subject to longer processing times, especially in light of the COVID-19 pandemic. We are all very well aware that there is still significant processing delays, and he just confirmed that once again. All right, again, new for 2022, reporting by third-party settlement organizations. As we've all already probably seen, whether it's on the news or on tax Twitter, Congress has tightened the de minimis exception to tax reporting by third-party settlement organizations, PayPal, Venmo, Zelle, the list goes on, by requiring reporting of transactions that exceed $600, thus eliminating the 200 transaction threshold. The American Rescue Plan Act also clarified that TPSO's reporting obligations are limited to transactions involving goods and services. This means that beginning in 2022, if you run a business where customers pay you via TPSO and you receive more than $600 in total during the course of the year via the TPSO, they are required to report the amount to the IRS, regardless of how many customers are paying you, and going to be then sending you a Form 1099-K payment card and third-party network transactions. It remains to be seen if our 1099-K line will then reappear come 2022 on business tax returns and Schedule C. So stay tuned there. Charitable deductions. The Taxpayer Certainty and Disaster Relief Act of 2020 extended the 2 charitable giving changes enacted by the Coronavirus Aid, Relief, and Economic Securities Act. The law allows you to deduct up to 100% of your adjusted gross income in qualified charitable contributions if you plan to itemize your deductions. Non-itemizers may claim a below-the-line deduction up to $300 or $600 if married filing jointly for charitable contributions made in cash. And our favorite, the child tax credit. Biggest change to 2022, both the advance payment of the child tax credit and the extended child tax credit comes to an end, but the effects of the advance payment will still be around, obviously, for 2022. Families who received advance payments will need to compare those advances with the amount of the child tax credit that they're properly claiming on their 2021 tax return. Taxpayers who receive less than the amount for which they're eligible can claim a credit for the remaining amount on their tax return. Taxpayers who receive more than the amount of which they're eligible may need to repay some or all the excess payment when they file. The IRS will send letter 6419 with the total amount of child tax credit received in 2021. People should keep this in mind. Make sure their clients are retaining these notices and submitting them with their tax information for their return preparation. Moving along now to administrative functions. I like to call this pre-season tax prep. We have 2. First being engagement letters. The tax engagement letter is usually the first written communication a tax practice has with its client each year, and it's also a very important piece of evidence that the firm is ever sued. The engagement letter can be either a first line of defense or evidence against the firm, and can be difficult to come up with the appropriate language to include in an engagement letter if the firm is starting from scratch. Even if the firm is not starting from scratch, the language should be reviewed annually. The AICPA does provide engagement letter templates, and many tax research services also provide sample letters. Some important items that you want to make sure that you don't overlook on your engagement letter should be services to be performed, fee arrangements, and the date tax information is due into the office. And last but not least, tax organizers. Second, but very important, pre-tax season administrative function that deals with tax organizers. For many firms, the tax organizer is the basis of our due diligence documentation for tax returns, and it helps us and clients also organize tax information in an orderly fashion. The tax organizer becomes an important piece of the overall package that makes sure that all the relevant information has been considered to prepare and complete an accurate tax return. Most tax softwares do come with a standard organizer that the firm can mail or email to an individual tax return client. However, it may benefit a firm to consider making changes beyond the standard to include some customized questions or information that is being requested, such as that pesky FBAR question, and now even that added virtual currency question, which I highly recommend you all ask every single individual tax client. Many tax research services also offer sample tax organizers. So in closing, I'd like to highlight a couple of NJCPA items that you might be interested in. If you're looking for new clients this upcoming tax season, or just at any time in general, be sure to enroll your firm in the NJCPA Find a CPA directory. The basic listing is free. Learn more about this at findacpa.org. If you missed the NJCPA annual tax seminar in December, it is now available to watch on demand for no CPE credit. Sign up at the On Demand tab at njcpa.org/events. Here you can also search for all upcoming NJCPA webinars and programs too. And for those who are anxious to return to in-person CPE, the Society's Bergen chapter is holding a federal tax update on February 8th in Paramus. Register at njcpa.org/chapters. And as always, I recommend that you join the NJCPA Federal Taxation and/or State Taxation Interest Groups by going to njcpa.org/groups. Thanks for joining us today. We will be back with a new tax episode soon. You can access all Issues Watch podcast episodes at njcpa.org/podcast. Bye-bye.